Hello everybody, hello, my name is Art and today I'm in New York here at RoboticView, and today we're going to be talking how to use Python to gather information about options. But today is just the first stream. Next week we're doing another stream about options and about how to use advanced strategies. Okay, so that's what we're going to be doing. So every Thursday we'll meet on this channel and we'll talk about different option strategies, and more importantly how we could use Python to spot lucrative option strategies and option deals. All right, so let me say a couple of words about myself if it's your first time on this channel. So my name is Art Yudin. As a matter of fact, I've been teaching Python professionally for quite some time, and I wrote a couple of books about Python, so you can find them on Amazon. But more importantly, I've been trading for quite some time, for more than 24 years or 25 years, because as a matter of fact, I've started my career, financial career, on the floor of Chicago Mercantile Exchange. So it's not only Python, so it's mostly fintech. So today we're going to be learning how to gather information about options. We'll talk about concepts and how we could use options to make some money. So one more thing, please do not take this live stream as an investment advice. I'm not an investment advisor. I'm not giving any investment advices. So this is just all examples here. They, for one simple reason, learning Python. All right, okay, good. So now I have this file that we're going to go through a little bit later, but if you want to follow me, you could go into the description to this live stream and you'll find a link to this file, so you could actually download this file and you could actually follow me with this file, and everything that we're going to be discussing will be in that file. If you're brand new to Python, so then what I would recommend you, so first of all, I posted a couple links to my previous videos, how to get started with Python or Python 101. Also, we do at RoboticView here, we do Python courses, and we do also Python for Finance Comprehensive course. All right. Now, so again, link to this file you'll find in the description to this video. As far as I understand, we have a bunch of people. Some of you probably familiar with options, some of you brand new to options, and I want to make sure that we're all on the same page. So that's why I want to do a little presentation and just say a couple of words about options so everybody will be on the same page. Now it's not going to be long, so I don't want to go dive too much into theory right now, because all my streams and all my courses pretty much all about practice, practice, practice. But still, that will help us to understand what we're trying to achieve here at the end of the day. All right, now first thing first, there are two different types of options. So there are call options and then there are put options. All right, and by the way, so I see that some people writing something in live chat. If you have any questions, because this is a live show right now, so you could send me your questions. I will be watching this live chat so I could answer you in real time. All right, because all our courses are in real time. So call option, what is it? First of all, options are contracts, and there are two types of options exist: call options and put options. So you could read it here that call option is a financial contract that gives holder the right, not the obligation, to buy a specific quantity of underlying asset. Now today we're going to be talking just about stock options. So underlying asset would be just some kind of stock. All right, again, not an investment advice, let's say Apple. All right, now, so I know it is probably difficult to understand options at first, but let me try to rephrase what we got here with just like plain words. So first of all, suppose you buy a movie ticket and then you have a right to go and see that movie, but not an obligation, right? You could maybe decide and change plans, and then you won't go there, so then it will expire, the ticket will expire. So that's pretty much would be an example of call option. So then also here we got put option, and again that's pretty much a contract, but this contract, so this contract gives you ability to sell something at predefined price. We call that strike price. All right, so I want to make sure that you could see everything, and I think my screen is kind of frozen for some reason. Okay, let me see what's going on here, because that's a live show. All right, I'm sorry about that, but it's not actually rendering what I'm trying to tell you. All right, let me check my, I'm sorry about that. Yeah, I just want to make sure that you could see this stuff. All right, okay, so put option could be used as an insurance. Think about it like this. Suppose you have a car, and then God forbid something happens to that car, so you could buy an insurance, and then basically what's going to happen, they will pay you for if something happens to your car. So options could be very good instruments, financial instruments for hedging purposes, like an insurance. And as a matter of fact, I have prepared a couple examples for you here. Call example, but I'm not sure why my screen is not rendering. Why it's not rendered? Hold on a second. What is going on? So it's still okay. Let me just give me a second, please. It's kind of frozen. I'm not sure why. Am I sharing the wrong screen? So people saying that maybe I'm sharing the wrong screen. I think I'm sharing. All right, now we got it. All right, sorry about that, but again, it's a live show. Many things could go wrong. So, all right, so I have a simple example, call example. And by the way, as a matter of fact, I got this data from yesterday. You could see July 10th. So suppose we have a call option, and remember there are two types, call options and put options. And that data I got here from yesterday, July 10th, 7:59. So 235 means strike price. And obviously it's not free, so you have to pay premium, pretty much like with insurance. And the premium is $9.70. So keep in mind that $9.70 is a premium or price just for one option. So usually what you do, you multiply this $9.70 price by 100, because you cannot buy options less than 100 shares. And here we got this condition. So there is a strike price 235. That's what we got here. So we have to pay premium if we want to buy this call. So that $9.70 times 100 shares gets us to $970. And options, they expire. That's very important to understand. It's pretty much, again, getting back to that example with the movie ticket, because movie ticket will expire. If you buy a movie ticket today and you won't go there, it will expire tomorrow. So all call options and put options, for that matter, they all have some expiration. And this particular one that I grabbed from Yahoo Finance yesterday expires on September 20th, all right? And let me explain you how that stuff works. Again, maybe some of you are familiar with that stuff, but I want to make sure that everybody on the same page. So current Apple price is $232, all right? So that's a current price, yesterday price, all right? So I don't know what happened today. It probably dropped a little bit. So then there are two outcomes. This stock might go up, or this stock might go down. You never know. Now, basically, what we're trying to do, we're trying to figure out, will it go up or down on September 20th? Because stock could go like rapidly up, or could go down, right? So now keep in mind that suppose if you bullish on Apple stock and you think that Apple will go up and up and up, and it's a great company, so then you could buy 100 shares. If you buy 100 shares of Apple, that will cost you somewhat around $23,000. However, if you buy 100 of contracts of calls on Apple, you will have to pay $970. Obviously, so this is a leverage. This is a huge leverage, right? And then basically, again, I'm trying to simplify everything right now. And as I mentioned before, this is just the first live stream, because next Thursday we're doing another live stream where we're going to be discussing like advanced strategies. So if you wanna make sure that you won't miss that one, please subscribe to this channel and give us a like. So, and then question, where will be the stock on September 20th? And there are two possibilities. Stock could go up or stock could go down. And suppose stock went up, and suppose on September 20th, Apple stock is 250. So basically you could do math, and your profit will be 250 minus 235. Why? Because 250 would be that stock price on September 20th minus strike price. You see, 235 strike price. And that means $15 difference times 100 will get us to what? To $1,500 minus whatever we have paid for those contracts, which is 970. So profit will be $530, and roughly that will be 54% on our investment. So yes, you see, that's pretty much leverage. And now there is another possibility. I'm not going to lie to you. There is another possibility. Suppose something bad happens. I don't know. Samsung will be outselling Apple, and maybe everybody will switch to Android. I don't know, but that's a possibility. And suppose on September 20th, stock will drop to $150. So then basically you will lose $970, which will be 100% of your initial investment. However, and I've seen this many times with sharp moves like that in the market, because again, I've been in the market since 1998. If you had 100 shares, then you would lose 8,000, a little bit more than 8,000, you see? Now here, obviously your loss will be much lower. But frankly, I understand what you're thinking right now. Nobody wants to lose 100% of initial investment, even if it's much lower than what it could be, right? So basically what I'm trying to say here in these live streams, we'll discuss how to use Python to find lucrative advanced strategies. You see, because nobody wants to lose 100%. Everybody wants to make 54%. And that's what we're going to be doing here. And again, what I'm going through right now, if you just join us, I'm just trying to explain the basics, how to use options, okay? Because obviously our goal not just to buy a call or just to buy a put, although sometimes that might be a good strategy if you know where stock is moving, but our goal is to learn advanced strategies. Now here we got put example, and again let me remind you that put is a right to sell stock. So you could buy it as an insurance. Suppose you have 100 shares of Apple and God forbid they go down as a rock, so then you would still have a right to sell them at strike price 230. You could think of it as an insurance, all right? And again, if you didn't have stock before, so then you could actually play it short, and you could assume that maybe Apple is overrated and maybe something's bad gonna happen to it, so what I feel like really bearish about it, and then you could actually buy put, and that would be pretty much the same as going short stock. So pretty much you could make money even when the stock drops. And here we got question, what is the current Apple price? Honestly, I do not know. Yesterday I think it was somewhat around 232, and again I'm using Apple here just as an example, okay? So the point I'm trying to make is this, in these live streams we'll be using Python to identify, to find, to filter these option strategies that will earn us some money. And again, it's not investment advice, it's all about Python. But let me outline what I mean by advanced strategies. So advanced strategies, you could actually, instead of just buy call or buy put, you could actually generate passive income by selling covered call. Again, I will explain this in details next Thursday, but let me just give you an idea. So pretty much selling covered call means what? You got a stock and you want to hold it for quite some time, but you think that maybe that stock has reached its potential for now, and you want to make some money on it. So you could actually sell calls, so you could actually collect premium, and that's very lucrative strategy. You could also create income strategy by selling put spreads, and you could actually be on casino, and we know that casino always wins in the long term. So here you could actually sell these put spreads, and that's pretty much what we're going to be doing next Thursday. Sometimes you want to buy a stock, especially when market drops, but you're not sure. Maybe stock could go even lower. So you could actually buy stock using a strategy called selling naked puts. That's kind of risky, and we'll talk about it. But that's also a possibility. But more importantly, what we're going to be doing in this course, we will learn how to identify strategies, how we could make money from selling volatility and time decay. What I mean by that, it's pretty much like an insurance company. Insurance company charges you every month for your car. And if nothing happens to your car, you're losing money, and that insurance company will pocket that money. So that's pretty much what we will be doing. And of course, there are many things might go wrong, but the point I'm trying to make is that insurance company and casino, they always win in the long term, all right? And again, I'm going to be explaining some finance here, but at the same time, I want to concentrate mostly on Python. And speaking of Python, if you want to follow us, as a matter of fact, in the description to this video, there is a special file that I provided. So pretty much all the code that I'm about to show you today, you'll find there. And you could download this file. And again, all these videos is all about Python, not about investment advices. All right, now, when I was preparing for this live stream today, I thought, all right, so we want to get actual data. Where can I get actual data? And the actual data could be found here at Yahoo Finance. Yahoo Finance, all right? Now, I thought about other sources of information too, but I don't want you to pay for their services, and I was looking for a free service where I could actually get data. Yahoo Finance is a very good source of financial data. If you want to trade in real time, if you want to do algorithmic trading, so then I would recommend you to use APIs from your broker, from your brokerage house. And again, in my videos, subscribe to my channel. I have a couple of videos how to get information from APIs. But Yahoo Finance, as a matter of fact, provides very good services. You could actually find all this information, financial information here. For example, speaking of Apple, you can find all the information here. And there are a bunch of Python libraries that will help you to get that information. And again, in the description to this video, you'll find my previous video where I teach how to use Yahoo Finance. However, recently they depreciated support for options. You see here, you'll find information about options, and they actually depreciated that service. That sucks, honestly. So what I decided to do, I decided to do it anyway. So I decided to scrape information from their website. So in my example here, I'm going to show you how you could actually grab information from Yahoo Finance or from any other website. Okay, now again, if you want to follow me, you'll find this file in the description to this video. And again, let me remind you, if you just join us, today is the first stream, and they're going to be a series of different streams. Next one's going to be next Thursday, when we're going to dive into strategies. So please subscribe to this channel and please give us a like. So first thing first, here I want to install Yahoo Financials. So that's one of the libraries. So I need this library to get risk-free internet, risk-free rate, because we'll need it for our price calculations. So if you're following me, I'm just going to install it here, you see. So now it's been installed. Then there is like really cool library. So this library we will be using to calculate fair option prices. And if you checked name of the stream, it's called the Greeks. Greeks, I'm not talking about people living in Greece. They're nice people, all right? But I'm talking about special letters that will help us to navigate in options and understand if you're paying the right price. Again, getting back to that insurance, obviously we all have car insurance, and sometimes you might say, hey, why are you charging me so much for a simple car insurance? Maybe it should cheaper. And basically that's the same question here in options. Before you buy or sell an option, you want to know if you get a fair price. So the Greeks, these letters, the statistical measurements will help us to identify whether or not we're paying fair price. And you see what I'm doing right now, I'm pretty much downloading all the libraries. So right now I'm downloading Selenium. If you never worked with Selenium, you'll be amazed, because Selenium initially was built for automation purposes, but most of the time people use it to gather information, to scrape information from different sources. And you'll see in real life what it's going to do for you. And by the way, if you just join us and you need this file, you'll find the link in the description below. By the way, subscribe to this channel, give us a like. So then here I'm going to explain you line by line what I'm doing here. So here I want to import a couple of libraries. NumPy is a core library for numeric Python. Pandas is a library called panel data. That's pretty much we will need to use to do all these data manipulation, especially in finance. We need to import data module in Python because we need to calculate time delta. I'll explain you, because remember, options, they got expiration dates, and that will help me to find options that I really want to. And then this library, it's for actual price calculations. So Yahoo Financials, I'll use just a little bit just to get some risk-free rate here. Matplotlib we're not going to be using today because Matplotlib is for plotting purposes. And all this is for Selenium that will go to Yahoo Finance and will grab that data. So I will import this stuff here, and that's a live show. So here you see we get today's date, which is July 11th. So that's current time in New York. So then for my calculations, I need risk-free rate, and usually we use 10-year notes. All right, so let me take a look what's going on. Too much space, and could you please hide the video? It's taking too much space and covering. Okay, yeah, sure, I will. Okay, so let me. All right, so here. All right, and again, the whole file is up there, so just click on that link. So usually for risk-free rate, we use 10-year notes, and I'm going to run it right now. And you see it takes some time because obviously we hidden the internet, we hidden their website, and apparently it's around 4%. All right, so speaking of Apple, that will be my stock. And let me explain you this. Now, basically what I'm trying to do, I'm trying to go to Yahoo Finance, and I want to fetch information. From this page, you see, from this page, and it's not Apple, it's just, I'm sorry, Apple. All right, so I want to get information from this page. If we go to options, you see that's the URL. That's the URL, finance.yahoo.com, Apple options. So that's what I'm trying to do here. So basically I want to replace the stock because right now I care about Apple, and later on maybe I want to switch to some other stock, all right? So that's what I'm trying to do here. So now here I have created some function. I'll explain you the purpose of this function in a minute, but let me explain you what I'm trying to do here. So here I want to mimic browser, and I want to hit this URL, and by that I want to automate stuff to get data from the from Yahoo Finance. Just want to make sure I keep an eye on your and by the way, if you have questions, you could always type me. I'm trying to keep an eye on that. So then here I want to fetch information, and take a look. Here we got expiration button. So here we got expiration button. So what I'm trying to do here, I'm trying to mimic this click, and I'm trying to identify expiration date that I want to get. Now I want to play safe, and we'll talk about what I mean by safe, different strategies next Thursday. But usually I want to buy or sell calls or puts that would be, let's say, roughly 2 months from now. So I don't care about July 12th. I care about September 20th. So basically what I'm trying to do here with my Python script, I want to automate the stuff. I want to choose September 20th. I want to click here, and I want to gather this information. You see? So that's what's going on here. So then here I want to get this information. How do I choose exactly that date that I want to get? Take a look here. This is a function that will take all expiration dates, and then I know today's date, so it's today, and then I want to create time delta. So I want to get all expirations at least 60 days from today, from July 11th. However, I don't want to go any further than 80 days. So I want to capture everything in between. So this function will filter all the expiration dates, and then basically I will choose the one that I want. So now I'm not going to be touching anything, and you could run the script on your own. But watch me. When I run this, what's going to happen? This script will take control of my browser, Chrome browser. It will go to this URL, and then it will click on the button and will choose that date that will be between 60 and 80 days from now. And again, I'm not going to be touching anything. You cannot see me, but if you run it, you'll see how that stuff works. So watch me. I'm going to give it a second. You see it starts that browser. I'm not touching anything. Then it goes to dates, and it chooses September 20th. Take a look. So here we get in September 20th, all right? So we're done with this. We could close it. We no longer need it. And then I want to fetch information from that page. And let me show it to you one more time. And I'm going to explain you these 2 lines of code. So again, what it does, it opens options, chooses September 20th. So now take a look what's happening here. So on this page, I want to gather information, all this stuff. I want to get it, all this stuff. And then if we use a web scraping technique, if we go to inspect here, we see that apparently all these numbers, they're wrapped in class table. You see selection table. So that's what I'm talking about. I don't know if you could see it, but that's pretty much it here, table. So what I'm looking for how to grab that table so I could actually download that data on my computer so I could manipulate it even further, all right? So that's why here I got calls and puts, and you see I'm looking for a table, and then from each table I want to get TR, which is table row, you see? So now if I run the whole script again, also in my script here I want to grab recent price, which, take a look right now for today's closing is $227, somewhat like that. You see, I need this price for my fair price option calculations, and then I could run the script, and basically I'm getting to this table. So let me explain you a little bit here. So I'm fetching all this information from all those tables, and then I'm using Pandas. If you're not familiar with Pandas, so here in RoboticView we do a bunch of courses, and we teach how to build these models either for finance or just for data analysis. Please check our Python for Data Science Intensive. This is where we teach how to use Pandas, and we got Python for Finance Comprehensive. Also, we got 2 programs. You'll find the links in the descriptions, all right? So basically here I'm cleaning data, and at the end of the day, I'm also getting this price, and I'm getting this table, you see? So this table, now I don't want to get, you might ask me, hey, wait a minute, in the original Yahoo Finance page, it was more information. Now I don't care about all the prices. I care about prices. So take a look one more time what I'm showing you here. So I don't care about all the strike prices, because here you see we got strike price, and I don't care about $5, $10. Now that's not important. I care about strike prices that would be closer to today's closing price. Today's closing price is 227, so I'm trying to get something closer to that. So that's why here when I'm getting this price, I'm saying, hey, get me 3 above today's closing price and 3 below today's closing price. That's what's happening here, because I care only about nearest striking prices, you see? And that's why we get here, you see, 230, 235, 240, and if we go a little bit lower, 225, 220, 215. Keep in mind that this table, pretty much as it says here, represents just calls, because there is another table for puts, but I believe that would be too much information for one day. So that's why we're going to be doing this series. We're going to do this series of these episodes, live streams, videos, whatever you want to call them, next Thursday and then next Thursday. So please subscribe to this channel if you don't want to miss them. So let's take a look what information we got from Yahoo Finance. So here I got contract symbol, date, which is today date, time, pretty much what we got right now, strike price, because time is not important for me. So here we got 3 prices. Price, that's a closing price. Bid, so pretty much price at which people willing to buy this, and ask, pretty much at price people willing to sell contracts. Change comparing to days, so we know that according to this, Apple dropped a little bit, all right, but that's okay. Now, the most important factor for option prices would be implied volatility. So let me explain you what implied volatility is. Now remember, I was comparing options. To insurance. Now, obviously, if you're brand new brand new driver, and you recently got your driver license, and you maybe just like in your early 20s, insurance company got no idea how you're gonna drive, so they will include some risk, and apply volatility would be risk, pretty much how much stock could move. And this is very important factor that we will be using in our calculations today, because implied volatility might change. Some stocks more volatile than other stocks. So for example, we know tech stocks, they might be all over the place. They might drop and go up and jump and do whatever. And then we might have some less volatile stocks that maybe move little by little. Maybe, I don't know, again, I'm not giving an investment advice, maybe like Verizon, or maybe like AT&T, something like that, would be less volatile. So implied volatility, very important factor that we will take into consideration. So basically what I want to do here, I want to calculate my fair price, because I want to know, all right, so people buying and selling these contracts at these prices, but is it a good price? Maybe it's overpriced, maybe it should be cheaper, or maybe it's a good deal, I don't know. So basically here I want to calculate maturity, and maturity would be our target date, which is, remember, we defined somewhere here. Where did we define it? So that's today. And maturity date we define here, because remember, our maturity date should be between 60 days from now, but no more than 80 days from now. So that's our target date. And I'm trying to calculate number of days here. And then also keep in mind, and that's pretty much what I teach in my courses, is that although we got this data, and all this data looks like really cool, these are not actual numbers. So in Python you have to use numeric data types. So that's why I want to take implied volatility, and I want to get rid of these percentage signs, and I need to convert them to float. Again, if you have no idea what I'm talking about, in the description to this video you'll find Python 101 video that we did before. And then here I will be using this really cool library that will use Black-Scholes model. So what is the Black-Scholes model? So there were two guys in 60s, I believe it was in 60s. If not, please correct me in the comments to this video. They actually created the model excuse me, that will calculate the fair price of an option contract. And Black-Scholes. So Black-Scholes model, so that's the most popular one, that here requires stock price, we know that one, strike, that would be different every time, risk-free rate, that we, if you remember, identified here, and I would like to get this risk-free rate dynamically, because that's how pro guys do this stuff. They would get it like they want to see what's going on in the market. So you see we fetched it here, so that would be our risk-free rate. And what else? Maturity, that's defined here, that would be number of days. So here, if you want to see that maturity, that would be 70 days. You see, 70 days. between today and September 20th. And the very important factor is volatility. So volatility comes from implied volatility. That's pretty much premium that market wanna get for those options, because people who sell in insurance, they also take risk, so they want to be compensated. And again, if you want me to simplify it for today, it's pretty much like again, Navi's driver versus a guy who got driver license for 50 years, never been in an accident, and everything's fine, you see. So that's pretty much what it means. So here I created this function and here this function will calculate fair price for an option contract, delta, theta, vega, gamma, rho. So these 5 guys would be the Greeks that I promised you at the beginning. I know that stuff sounds like Greek to you right now, but I'm gonna explain you. Now, why is this so important? Because pro guys who trade in options, they use these Greek letters and Greek and these statistics to evaluate contracts, because obviously what we want to do to make money and to find lucrative deals, we wanted to find overvalued contracts and we want to buy undervalued contracts, and these measurements will help us to do that. But first we need to calculate that, because unfortunately we cannot find this information here. So here I have created a function that will calculate that stuff, and I'm passing these 2 things that we need, strike and implied volatility. And if you have no idea what we're doing here, please watch my previous videos or sign up for this channel or take our course, because apply is the only right way to iterate through the rows in Pandas. Because let me show you what I'm trying to do here. I take this called df and pretty much I slice that data frame, this table, and here, okay, it's a little bit jumpy, sorry about that. So I slice that and I grab just 2 columns that represent strike and implied volatility. That's pretty much what's missing for this formula. And now what I want to do, I want to iterate row by row, so pretty much like a for loop. And I want to apply this function that I defined here to all the rows. All right, so that's what we're doing here. Now I want to save information that I just calculated here. And that's why I have created these new columns. So then, just to make it a little bit cleaner, I want to drop columns that I don't need. Now, what I mean by that, so if you take a look here, calls data frame, now don't have stuff that we had before. You see here we had date, time, Eastern time. I don't need that stuff. Like, frankly, I don't care. I know that it's recent, it's got to be recent, so that's why I decided to clean this data a little bit. So I dropped those columns. However, I created new columns such as my fair price. So this price, this is market price, and this is my fair price calculated with Black and Scholes. Black and Scholes. Also, I have calculated delta, theta, vega, gamma, rho. All right, so let me explain you what these Greek letters mean and why they're so important. Let's start with the delta. All right, let me pull up my little presentation. So delta pretty much is expectation how much price will change based on the price change in underlying stock. So again, keep in mind that options contracts that would depend on the price of something. So in this presentation, we're talking about stocks only. So suppose we have Apple stock and Apple might go $1 up or might drop $1. So based on that increase or decrease, delta will tell us how much our option price will change. So let's take a look here. So delta, suppose here we'll take this one, strike price 230. So current price is somewhat around $9.30. So now this 48 cents. So pretty much if Apple stock go up, then this delta will be added to this price. So it will be 9.33 plus 0.48. You see, that's what's going on. So that's how it will change. Now keep in mind that delta will change with time. And again, it all depends on expiration and where stock price is. And again, if you want to know more about the stuff, subscribe to this channel, because next Thursday we're doing another stream when we're going to dive more into strategies, because today we're just talking basics, what that stuff means and how to use it. But then we will talk how to identify lucrative option advanced strategies. So 48 cents will be added to this price if stock goes up, or if stock drops $1, so 48 cents will be subtracted from that price. So, and again, keep in mind that that's kind of theory, all right? So next Greek letter is gamma. So gamma, and you'll see it here, pretty much will identify how delta will change. That's also important because, as I mentioned before, this number is not constant. It will change if okay, so stock was 227. So if stock keep going up and up and up, call delta will change. And this is pretty much gamma tells us how much it will change. So delta will change by 0.01, you see? So that's how it will change. Also, we have theta. Theta is very important indicator, because remember, these contracts, they expire and they decay, time decay with every day. So what it means that every day this contract theoretically should lose 7 cents. So time against call buyer. If you buy a call, you should expect that it will be losing around 7 cents every day. And suppose if you bought this contract and stock is not going anywhere for, let's say, 10 days, you will be losing 70 cents according to this theta, okay? So that's pretty much what it means. So also known as a time decay, measures the rate at which option value decreases. And again, that's a theta, and time decay is a good thing and a bad thing at the same time. Why it's a bad thing? because if you buy a contract, then this contract will be losing money every day. However, if you play insurance company and if you sell that contract, then you'll be making this little by little every day. You see, that's kind of cool. And that's exactly the strategy that we're going to be talking about next Thursday. So please subscribe to this channel and give us a like. And two more. Here we got vega, pretty much that measures sensitivity of an option price to changes in volatility. So let me show you what I mean by that. So remember, here we got implied volatility. And we want to know what will happen to the price of that contract if volatility changes. And keep in mind, volatility changes pretty much every day, because stocks might go down and will, as you could hear on TV, people say, hey, market is volatile. And some stocks might be really, really volatile, like small cap stocks, or maybe some, I know, like some internet stocks or some tech stocks. They're really, really volatile. They could be all over the place, dancing like a ballerina, dropping, jumping, I don't know. So pretty much this vega number will tell us what will happen with the price of that option contract if volatility changes. And the last one, frankly, I don't use it too often, because this one will measure sensitivity of an option price to changes in the risk-free interest rate. So let me show you what I mean by that. Now here, remember, we got risk-free interest rate, and we all hope that, and by the way, today is July 11th of 2024, we all hope that central bank, Fed, will decrease rates this September. So right now, pretty much risk interest-free rate is pretty much around this number, right? More or less, roughly. But what will happen if Fed will lower rates in September? So then pretty much you could take a look at this value and say, all right, so the price of contract will change significantly by 19 cents. You see? So then it will be like really, really important. So the point I'm trying to make is that in order for us to work with these strategies that we're going to be doing in this series of live streams, and it's called Options, Python for Advanced Strategies, we will be finding lucrative deals, and we will be analyzing our profits and losses before we get into trade in this channel. So then we need to understand how to value those contracts. We need to understand Greek, so we understand what will happen to the price of that contract in future, and what should we expect to happen if stock goes up or goes down. So that's why that stuff is very important, and Python is a great deal of help here, because you could analyze this. And just as a teaser, I have prepared this little example here. You could do conditional statements. So for example, I got my own Black & Scholes price, and I was curious if my Black & Scholes price that I just calculated a couple of minutes before will be greater than closing price, and I was running this condition that gives me true or false. Apparently no, these calls are fairly valued, so I would say that pretty much fair value, because you see, according to my calculations, this call with strike price of $230 should be priced at $9.26. Keep in mind that Black-Scholes gets you theoretical price. In real life, it's, you see, 9.33. So yeah, I would say that's a fair price. It's not that much difference. It's pretty much between here, so that would be a fair price. But sometimes using this technique, you could immediately identify undervalued or overvalued options, and that's what we're going to be doing in these streams. All right, one more little thing before we call it a day. Now, this is what we're going to be doing. So we're going to be talking about option strategies. We're going to talk about covered call, and we will be doing all these calculations with Python, and I'm going to show you how we could plot this so you could actually understand how you could manage your portfolio, how you could make money, and how much money you could lose, what is your risk, how you could manage your risk. And Python is a great deal that will help you with that, because you could scan thousands of prices just like that. All right, so that's pretty much what we're going to be doing in our next live stream, which I'm planning for next Thursday. And again, subscribe to our channel. Please also go to our website, RoboticView. And by the way, here you'll find a bunch of free resources. And if you're brand new to Python and you have no idea what I'm talking about, so please subscribe. It's a free subscribe to our news. And here, I believe a couple of weeks from now, July 23rd, we're doing Python 101, totally free course. So if you want to see what Python is about, so then you could actually take this course so you could see what Python is about and how to get started with Python, or you could watch one of my previous videos. And again, please explore our courses. And I guess that's all time we got for today. Let me take a look at our live chat, what's going on. Yeah, so anyway, people asking about links. All links in the description to this video. Please check it out. And also go to our website, roboticview.com. So here you'll find even more information. How often do you actually see opportunities underpriced? Quite often, Bruce. As a matter of fact, I just made a couple of trades recently, yes. And I just took this example with Apple because Apple is highly traded stock, so probably it never will be overvalued or undervalued. But still, even with Apple, you could implement some interesting strategies where you could make some money. However, we could build a scraper that will scrape, let's say, all stocks on NASDAQ or New York Stock Exchange, and will identify anomalies, or maybe identify some interesting setups. So that's pretty much what we're going to be doing in these streams. And again, please subscribe to this channel and give us a like, and I'll see you next Thursday. I hope you really liked what we've been doing today. Again, the file you'll find in the description to this video, or if you go to resources, view all videos. So here you'll find more information. If you're brand new to Yahoo Finance, you'll find information here. If you want to get data from APIs here, and that's pretty much would be a file for today's live stream. All right, what broker do you use? I'm not going to advertise anyone, but in our financial courses, we actually built Python algorithmic trading platforms that could be connected to all major brokerage, because Carlos, answering your question, all major broker houses got API, Python APIs. All of them. Again, I don't want to mention anyone, but pretty much all major brokerages provide APIs for Python because Python is very, very popular. Okay, yes, you cannot run this in Colab because Colab would require different setup. So if you want to run it in Colab, you would need to you would need to Google and see how to use Selenium in Colab. It's not that difficult, but yes, you could run the script in Colab too. All right, guys.